Hello, everybody. I hope you are doing well. You are enjoying the morning. This is the last panel just before the lunch. So we will try to keep it dynamic and make it enjoyable. Everybody I know is hungry. So yeah, let's try to make it a little bit enjoyable. My name is Itxaso, and if you didn't figure it out yet, I'm Spanish. And I'm an investment director at Notion, which is a venture capital firm based here in London. So I've been here for 10 years. You can't believe it, right? But yeah, I've been here. So we are investing in companies which are related to the topic today. I led investments in companies like Onfido or DueDeal, which is outside, and many other investments in FinTech space too that might be relevant for the case. Obviously, a lot of data, machine learning and artificial intelligence at the moment. And we have an amazing panel here today. We are going to be talking about basically how big organizations are managing and fighting against fraud, AML, and financial crime. I think I will do a quick introduction of the panel. Maybe we can start with Shilpa, who is sitting here next to me, and she's basically the head of financial crime at Santander UK, right? Previously, she was at Barclays and working on many of their solutions, which in fact impact the consumers' user experience and so on. Maybe you can tell us a little bit more about your background, Shilpa.
Sure, happy to. Good afternoon, everyone. I do appreciate we are between you and lunch, so we will try and keep it as brief as possible for everybody's benefit. So I'm Shilpa Arora. I head up financial crime prevention at Santander UK. I've been doing this for a year plus. Prior to that, I was with Barclays for over a decade in various technology programs, including financial crime, and headed up the Line 1 function over there. Stephen, I caught the end of your talk there, and I can quite relate to some of the things that you're saying. It is quite an interesting environment we find ourselves in, where the regulators themselves are innovating, and it's innovation and different ways of doing things is the way forward. So that'll be the focus of what we talk about here. Thank you.
Fantastic. So then next to her, obviously, everybody has heard, or some of the people in the room at least, the talk by Stephen Platt, who is the CEO, the chairman and CEO at KYC Global Technologies. And you are building a couple of solutions that you already talked about during your talk, but I'm conscious some of the people were not in the audience. So maybe you can tell us just a little bit about those and basically the risk screen or the KYC 360. Yeah.
Okay, so we have a number of solutions which taken together make up a complete AML ecosystem, from screening, onboarding, through to batch, through to lifecycle risk management technologies. I don't want to sit up here and I think people want to hear the substance of what we've got to say, so I think that's probably enough from me. Thank you.
Okay, great. Next, John Cusack, and John basically is the co-chair of the Wolfsberg group, and as you probably know, this is the association of 13 major banks trying to fight financial crime and AML and fraud. Do you want to tell us a couple of words about it?
Yeah, thank you, and good afternoon, everybody. The Wolfsberg Group has been mentioned, 13 large international banks. Mentioned two of them already, Santander and Barclays, but many others. We're a group that's been set up since 2000, really focused on fighting financial crime. That's in three areas. That's setting standards and publishing them. In fact, yesterday we published some new guidance on tax evasion, which some of you may have seen, engagement and benchmarking across the industry. So we're very much focused as an industry group on AML, CTF, KYC, and looking forward to today.
Excellent. And last but not least, Jeff, who in fact is coming from Philadelphia, is joining us. He has a background on data and technology. He's the CTO at the moment of RDC, and he has worked with many startups, maybe technology companies in Silicon Valley, and at the moment working with the Federal Reserve Bank of New York. And do you want to tell us a little bit more about that?
Sure. Hi everybody, thanks for coming. RDC maintains the world's largest database of criminals and bad actors and tries to prevent them from entering the financial system or gaining access to the financial system, primarily through adverse media screening. I joined RDC only recently. Prior to that, I ran the data science program at the Federal Reserve Bank of New York for about 5 years. And before that, I did startup companies in Silicon Valley for about 25 years.
Great. So we're going to structure the discussion a little bit first around the technology, and then a little bit more about the regulatory framework and what the regulation agents and players are doing in the space to talk about MAL and fraud and so on. So let's talk about technology a little bit. Maybe John, you can start if you want, talking about a couple of use cases of technology in the space, just as an introduction to fight MAL, fraud, and financial crime.
Yep, happy to. So we'll try and do this really quickly so we can get through as much substance as possible. So it's amazing to see so many vendors here, or partners, as I like to call you. And the area of coverage is quite substantial. But I'm going to focus in particular from an FI's perspective on one particular area, which I call surveillance, which actually involves the two gentlemen either side of me who've got very successful products and services that they offer to very large, medium and smaller financial institutions and others. It's really important. All the vendors, all the partners that we work with, even all the ones that are here, really have got a couple of motivations. They're either selling products or services that have a revenue or client experience bent, or they're either reducing risk or helping us manage cost. Right? Those are the three things, and everything fits into that bucket. In the financial crime space, it's pretty much the last two, and it's usually a combination of the two of them. In the surveillance space, let's leave KYC to one side, it's a very big, large area. But on the surveillance space, what do we want to see from technology? Well, we've got four big problems to fix, and Stephen talked about some of the legacy issues that he sees within certain financial institutions. I mean, that big issue around data and having data quality, big issue around segmentation, making sure our clients are in the right place and we can spot all of our clients and our common clients so we can run processes against them. The screening process itself is highly inefficient. Stephen talked a lot about that a minute ago. And the transaction monitoring system is even worse, right, when it comes to conversion ratios and productivity. So those are the four problems we've got in the industry. I think the big four problems in surveillance, and technology can help us, is not the solution, however, but can help us in relation to those four big problems.
Mm-hmm. Fantastic. Very good. And in terms of data analysis and use of data, maybe Stephen can tell us a little bit more on how could financial institutions and other organizations use data to fight AML and fraud and so on.
Are you referring to their own data?
Both their own data as well as external data that they might buy from other organizations.
Conceptually, this is not difficult. You are fixed with information in the form of data about your customer relationships, and you need to utilize that data in the most efficient way, whilst having a keen eye on enhancing the customer experience, of course, which is a major, major challenge. You need to utilize that data to screen against external data sources, to ensure that you are, A, not doing business with bad actors, and B, the business that you are doing is being done in a way that is completely defensible, for which read it is being done in a risk-based fashion. And as and when events occur within the relationship that might indicate that the risk profile is moving, or that there is some external event about which you need to be concerned, you need to be seen to react to that as rapidly as you possibly can. That's essentially what we're utilizing the customer data and the external data to do.
Yeah, and obviously we use technologies to analyze this data and to make sense of the data, right? I think obviously, Jeff, you've been working in this space for a long time. Do you think the bigger organizations are looking to buy those sort of solutions externally, or are they looking to build them internally?
I would say both, but I think honestly the biggest challenge is not a technical challenge. The technology is relatively straightforward. Machine learning is not rocket science, even though it's called machine learning. But the real challenge is coordination and cooperation or collaboration. So each individual bank will have access to their own data to a greater or lesser degree, depending on how tidy their systems are. But it really takes the entire financial system working together to effectively screen and to notice trends. Banks are obviously very loath to share data with each other. Having a repository, a disinterested third party, where obviously the data is not going to be commingled and shared with each other, but the results of the analysis can be. So, for example, not only you can tell a bank that, give them an alert, you may want to pay attention to this individual, but you may also be able to do peer analysis and to tell them how their reaction to, for example, an AML or fraud alert is different or similar to their peers. You can also advise them about trends. We're seeing a lot more mentions of this particular type of activity in this region, for example.
Can I add to that? I mean, the question is, are we seeing banks build their own or buy it in? And we all know that historically, some banks have gone down the path of building their own and have deeply regretted it. But you've got to have some sympathy for that decision, because what happened historically is that they bought themselves a solution which they've paid a lot of money for, and they've got it out of the box, and it hasn't quite done what they've wanted it to do, and it's cost them tens of millions of dollars to try and adapt it, because these solutions are completely inflexible. And so the reaction to that is, well, let's build our own. The problem with that, if I can draw a rather crude analogy, is, if your nearest and dearest needed heart surgery, would you go to the best, or would you train yourself to do it? I mean, banks are good, some of them better than others, at running banks. They're not specialists at the development and deployment of cutting-edge technologies. So whilst I've got sympathy with the fact that many of them have built their own historically, it hasn't always worked out well. And so they're looking to buy in. They look to the big players to buy in, but that's legacy tech. They've got all sorts of barriers to entry for the smaller RegTech players who've got the best technologies with these ridiculously arduous RFP processes. I mean, I remember back in the day when we started going through all of those, and they are artificial barriers to big businesses getting access to the best technologies.
And I think Shilpa might be able to give us a little bit more of information about it, right? Because you are at Santander now, you've been before too in other big financial institutions, right? So can you tell us a little bit more about how this is working for you and how are you navigating that?
Sure. Perhaps we kind of step back a bit and kind of try and understand what we are trying to do from any bank's perspective, right? So the net is closing in on criminals from every bank. It doesn't matter what bank. Every bank is better now than it was 10 years ago in fighting financial crime. That is fact. There is a lot of ground to cover, and 10 years later, we will be in an even better place. That is also, it's not yet fact, I can't say that, but we're getting there. So if you look top down at how a bank looks at its financial crime risk, so there is a translation of what is regulation requiring us to do. There's also a concept of what is the right thing to do here, and then translation of that into policies and procedures inside. Separately, especially large banks, understanding what is our risk exposure, what is our enterprise-wide risk assessment telling us our risks are, so you can focus across the enterprise on specific areas. So that's quite key as well. So a lot of banks start with a translation of regulation into policies and procedures. What is an enterprise-wide risk assessment? What are the areas of focus? Which customer segments or which business areas or specifically which entities within the wider group that need focus on? Starting from there, then you look at, right, what are the key risks? What are the inherent risks? What controls do we have? Are they effective? Are they ineffective, or somewhere in between? And where we class controls as ineffective, then what is the investment needed to make this better? almost every bank goes through the cycle of, are we compliant? That is the first question to ask ourselves. Are we compliant? If the answer to that is yes, then we come to, right, we need to be efficient, we need to improve customer experience, this is not the right place to be. So I think from Santander's perspective, we are there in terms of how do we make this better for our customers, for our colleagues, as well as the efficiency piece of, to what you were saying earlier, Stephen. We can't have thousands of false positives only to find one true match after 70,000 alerts have been investigated. That is not a position we want to be in.
And obviously that impacts the user experience too, right? On your customers.
Eventually it does. The more nuanced you can be to understand what the risk is, the better the information you can gain from your customers or from public sources, and the better the whole experience is, be it for staff or for customers. So in terms of the use of technology in banks, absolutely, we've been through the cycle of, should we build, should we buy? Often buy is the way to go for all the reasons that we've previously discussed here. There are other experts who do it well, industry recognized solutions. So that's the route we have gone. But equally well, most banks are now having an open approach. It's not a one solution fits all. Even if there's business being done with one vendor, industry vendor, looking at what are the proofs of concepts we can run. Is there something we can improve? Sometimes it's even a layer on top of your existing infrastructure to go, right, let's improve it first before we rip it out and transform it all together.
And going a little bit around that, I think, John, maybe you can tell us a little bit more about the selection of those technologies, right? Because the market is full of players, newer ones, older ones, cheaper, more expensive, and so on. But how do you really filter the ones that are good for you and identify the ones that are good for your organization?
Well, at the back of your booklet, you will see a company on here that I've just been pitched to outside, his first right out there, called RegTech Analyst, which is, he says that's what he does, and he writes 2 pages about everything. Actually, it's pretty good. So if you're looking for who's out there and doing what, it's probably in his database, so go and see him out there on the right. I'm not his agent or his getting paid for that, by the way. On a more serious note, the question around build or buy, I actually think there's a third option here. And it was what Marcus Schultz was talking about earlier. Marcus and I work very closely together. When we turned up at Standard Chartered in 2014, we looked at our legacy systems and we looked at significant enhancements and remediation we had to deliver, and we had to deliver that in 3 years. It took us 5 because that's the way of it. And we spent, can't tell you how much, but way too much, a lot of money. Now, what I would hope would exist next time I do this, which will be never, will be that there are industry platforms available for not just the large banks in this world, but actually what I worry most about is if we're going to move from old legacy to the new world, which we will inevitably, and use a lot of the things that are being suggested in this room and elsewhere. If we're going to do that, then actually change programs and bringing all that in-house is possible in some large institutions. And being able to accommodate AI, for example, in an alien infrastructure of legacy banking is extremely difficult, even though actually we've been successful in pulling that off. It's difficult and it's very costly as a result. What we really need is an industry, though, for the medium-sized banks and the smaller banks that can't do this, or will fail if they do this, is actually platforms. Right? This is not, it is rocket science to a certain extent, right? But actually screening platforms, right? Every international payment gets screened on average 6 times. Basically using the same technology, using basically the same standards, using basically the same fuzzy match or a bit different. That's not very efficient. So we've got to build these things, right? Rather than everybody trying to build their own, pretending they're better than anybody else, because they're not, right? We've got to join together and work and build these platforms for the real activities, that the bigger activities that we do. More bespoke stuff, absolutely, people should run, but actually these need to be available more broadly. And there is a sense that there is a coming together, both from public and private sector, that affordability challenges, but also skill set challenges are scarce and getting more difficult. So we've got to build some of these things. And I see the next 5 years as being part of that journey.
Are you going to?
I think it's a great answer. I'm a little bit sceptical about that, in the sense that
perhaps it's born out of my natural cynicism from doing these inquiries over the last 25 years. I mean, I think in a free market system, all the players in that system recognise that the way in which they manage risk is a way of gaining competitive advantage, and we only need to look, for example, at the fine levels that have been imposed on institutions that have been getting this wrong, despite the enormous investment that they've been making in systems, to see that it can have a material it can have a material impact on, as it were, the well-being, the financial well-being, and so on of a business. Now, the idea that all of those market participants, or many of those market participants, may join together to adopt some sort of common approach through the utilization of unified platforms, thereby removing what some would regard as a competitive advantage in getting this right, I think, I'm a little bit skeptical about that, because a lot of organizations do seek to gain an advantage through this arbitrage. So I don't know. I'm not sure I'm right, but that's my immediate reaction to it.
Sorry, may I add something? Sure. So taking that a step forward, it's not just the collaboration across banks, it's collaboration with the law enforcement as well, which kind of takes us that one step forward. I mean, ultimately, what are we trying to do here through all this, be it regulation or be it that's the right thing to do? The net is closing on criminals, and how do we achieve that? So better SAR reporting, updated SAR regimes, and that is the way forward, right? Irrespective of competitive advantage. That's what each one of us is also trying to do. So we shouldn't forget that collaboration is kind of quite key.
Could I just add to that? Because it's so important. There's no point us replacing what we've done in the past with just better ways of doing what we've done in the past. It's not going to work. What we have to do is, Shilpa said, we have to work much more closely with law enforcement, public-private partnerships, information sharing, actually see the information that's available, not just at Stanchart, but also HSBC and Barclays and Santander, so we can actually pull together that picture. So we shouldn't replace what we've got with better technology that does slightly better in our own environments. We know what the future looks like. Whether we get there or not, Stephen, I don't know. And I've got some cynicism myself. But we're going to try, because I think that's where we think we'll get better results in the end.
I will in fact ask Jeff to add to that, because you are working on the data science team, right? And I think what are the barriers for that collaboration when we are talking about data?
Many and varied. So RDC was started as an industry utility, right? So we were founded by 20 of the biggest banks in the world, but as usually happens, one of them wanted to lead and expected all the other ones to follow. This has happened over and over again. It's happened in Singapore, it's happened in Hong Kong, it's happened here in the EU, it's happened among the LISIC banks. I don't have a silver bullet that will get every financial institution, or even some of them, to collaborate immediately and openly, but what I do see happening is that we're beginning to nip away at the edges with the help of regulators. The regulators want to know not that you're going to make your customers, make their supervisory institutions compliant, but that you are part of the conversation and you're facilitating a conversation among regulated entities. That goes a long way towards facilitating the collaborative, I wouldn't say sharing information, it's sharing the analytics that are based on a pool of information. If you start saying sharing information among banks, it doesn't go very far. Controlled sharing of analytics, however, is a much more palatable thing.
Mm-hmm. Good. So we are going to take one more question before we go to a pool. So I would like to show the question for the pool on the screen. And everybody, I think you've been here from early in the morning, so you probably have already the app, but you can respond to the question while we are going through one more question here about technology before we talk about regulatory framework. But I think there is one question that I would ask now about the new technologies and new startups and everything outside. How can we build confidence? Because we were talking a little bit about compliance, we're talking about legacy systems, and how can we build basically confidence on those new technologies when we are, for example, working in a big financial institution and trying to fight against financial crime, right? So how do you build that confidence, Shilpa?
It's a good question. First of all, the number of players out there, distinguishing what, who is going to be your partner. It is an important and a difficult decision for a financial institution to make as well. However, I think we've been helped by, the sandbox environment the regulator themselves have set up with through what they are doing with supporting the small firms and giving them that kind of space to be able to play around in a safe environment and innovate. And the fact that the regulators also are looking, if you look at the FCA's business plan that was published about a month ago, looking to use these technologies to monitor the financial institutions. So, it gives, if anything else, the very powerful statement to the financial institutions to look at this if they weren't already. From Santander's perspective, we're doing both. We also have our legacy systems. It's not easy to just rip out and lose them overnight, but equally well also looking at what else can we do over and above that. We run proof of concepts, that is how you build the confidence. It's not an overnight thing. It's a slow process. And to the point that Stephen made before, I think, where RFP processes can become quite long and tedious and there are legal procedures to go through, running a small proof of concept in a safe environment and then look at the results and then build that partnership slowly but steadily, which means it's beneficial to both parties. So that's kind of how we're going about it.
Excellent. Stephen?
Yeah, I mean, it's a terrific answer. The one thing I would add with reference to the regulatory sandboxes is that I have worked historically with a whole range of different regulators, both on and offshore, and I've made the point to them many times. I need to be careful what I'm saying because many of them now use our technologies, but I've made the point, and I still believe this to be as true today as it ever was, that regulators get the license holder behavior they deserve. And the truth is that many regulators are not leading by example. So I talked in my earlier about the data challenge. If you go in and look at the way in which regulators are actually managing and marshalling and utilizing the data that they hold on their license holders, the banks, the wealth management, et cetera, it is as shambolic as the position within those license holders vis-a-vis their customer data. And so many jurisdictions, for example, have recently been put through national risk assessment exercises, and the result has been that regulators have imposed very onerous reporting obligations on their license holders to report information on their underlying books that they've never reported previously. It's fascinating to observe what regulators have actually done with that data. I tell you what they've done with it, sitting in cardboard boxes in dark rooms. And so, you've got to lead by example. And I think that we're beginning to see attitudes shift a little bit within regulators, but certainly not fast enough.
Yeah, so that was a good response, which takes us a little bit to talk a little bit about the regulation. But let's look at the pool, because I think it's very interesting that everybody who responded said that they are trying to implement new technologies and use new technologies. Nobody said yes as a statement, which means yes, we are getting there, but definitely the challenges that we talked about, they are on the compliance side, on the user experience, on the data side, right? They are still there. John, do you want to add something?
We've certainly seen in the last couple of years real cases of deployed emerging new technology, AI, within large financial institutions, especially in the screening space, and we've seen it in cleanup of data and segmentation. We've seen that, so that's okay. That's really good. A couple of challenges on it, not just around, and the UK is quite good in relation to looking and forward thinking in relation to new technology. The issue, though, isn't always whether or not something new is useful to use. Most people will always allow us to do more things. Right? It's not that difficult to get people, but when you want to switch something off that's been on for 20 years, where there's a huge crutch that's the thing we rely upon, and that's the thing that our supervisors only understand, and they don't really understand the new things. If you want to switch that off and go with something new, good luck. Or you run them in parallel for a time, and how long is a reasonable period of time? And does any CFO really want to run two of these systems with the conversion rates that they have even on the better stuff? So we've got to get our story straight here. in relation to what we want to do and why, and we've got to bring the regulators along with us. That if the new technology is better because it saves money, they're not generally interested. If it's better because it helps fighting financial crime effectiveness, then they are more interested. And if that can beat the legacy, that should be sufficient. But the identification of financial crime in the new will be different to the old, and we will lose something by turning off the old. But the gross or the net result will be better. We have this phrase that some regulators kind of use, which is no SAR left behind. Right? Which is, if your old system means that by changing to a new one, it's not going to find some stuff it found in the old one, but overall it's better in the new one, they're still concerned about that. So those kind of discussions are really tricky, and that's going to affect our ability to deploy some of this stuff, because we've got to move from where we are to where we want to get to, but we don't want to make mistakes along the way and compound the inefficiencies in the system.
Can I add something there? Just picking up on the point that the regulator's less interested in the efficiency piece and more interested in the fighting financial crime, but a bank is interested in both. If you look at the macro picture of what banks are faced with, and I'm not talking financial crime at all for a second, then margins are being cut, there's more competition on the ground, there's significant challenger banks, particularly in the retail space, who are kind of eating away at existing customers. There is the new generation coming up who isn't bound by the bricks and mortar and who want to go and bank in a very different way. So coupled with that challenge, I don't think any bank needs any encouragement to start looking at, can I transform this space completely and make it more efficient, save costs, and what is my cost to serve per customer, and can I reduce it to the extent possible? So this is where I think the balance is to be drawn. So everyone goes through the journey of, am I compliant first? But now that most of the bigger financial institutions at least are getting there, the next step naturally is to look at, right, I don't want to lose my space in the marketplace, and how do I retain that advantage? And therefore the cost and transformation automatically becomes the next best step.
Totally makes sense. Absolutely. So before we go to the questions from the audience, I would like to ask one more question about the regulatory agencies, and taking into account that we are pushed in terms of the competition and the business that we need to keep running. What are the regulatory agencies doing to help organizations navigate a growing number of financial crime issues or fraud issues, and how are they helping organizations integrate those technologies? Maybe Jeff, you want to talk a little bit about that?
Yeah. So in my discussions with regulators, so first of all, I agree with everyone that the important thing is to be proactive and to reach out to regulators and work with them. In my discussions with regulatory agencies, they realize that they're a little bit behind the ball in terms of technology and oversight of technology. They would welcome working directly with banks and having the discussions about what regulation looks like, what compliance looks like in the presence of using machine learned models. What they're looking for, and I can't speak for all of them officially, but is they're used to using models, predictive models. They've been using them for decades. What they want is the same kind of description that they've been getting all this time from economists. They want to know what the model does, under what conditions it will work, under what conditions it won't work, and they want it in plain English. If you give that to them, I think that goes a long way towards satisfying regulatory compliance.
Yeah, totally makes sense. So let's open to the public now, in case there is any question. Anybody has any question from the public? There is not. There is one question here. So 1 second, they are going to bring you a microphone.
Sure, thanks guys. Do you think the regulation itself is strong enough to solve the challenge of modern money laundering in its current and future form? I'm really interested in particular around the lack of required collaboration across the industry. Do you think that's a missing component or what?
Yeah, so I do. If you read the regulation carefully, pretty much we can do everything we're doing currently, except I can't share information with HSBC. Right? I'd like to do that around not everybody and not all our clients, but around certain areas where we've seen suspicion either coming from them or they've seen suspicion coming from us. I'd like to do that. can't do that. Can do that in the US, can't do that anywhere else in the world. So we've been very clear that information sharing limited with safeguards will significantly help. We also want to get more information from government. We get not enough. And there are issues around obviously releasing information that's confidential around, people, persons of interest subject to investigation. Again, we do that on a limited basis in the UK through the GIMLIT, for example, the Information Sharing Partnership, but that's tactical, it's not operational, and it's not industrialized, so we want to do that as well. So those are two key changes we'd be looking for. If we can make those changes happen over the next couple of years, and people are talking about those, that will increase exponentially the ability for us as an industry to work together. I'd like it a bit like the cybersecurity space. Cybersecurity space operates like that now. So an attack on one bank is an attack on all the banks. Attack on one private sector is also an attack on the public sector, and we work together across all of that. If we were reimagining how to do fighting financial crime in 2019, we'd do it that way. That's what we do, but we've got restrictions in place that prevent us from doing that. So there's reasons for that, there's some good reasons for that, but we should be open to at least discussing that.
That was a fantastic question. I think Stephen has a little...
Yeah, I talked in my speech about the aviation industry, and one very interesting contrast between financial services and aviation is that in financial services we have an appalling collective industrial memory. So if you look at the anatomy of scandal and failure over the course of the last 30, 40, 50 years, there's a real commonality of causation. Now, one of the reasons for that is precisely because we don't share data, we don't share the learning from these. Whereas, for example, in the aviation industry, every time something comes down, the CAA or the equivalent goes in, they conduct the inquiry, they identify the causal factors, they publish it, it's shared, there are industry bodies that look at it, they analyse it, and then that is then applied in the control environments of each of the airlines. And it's a brilliant way of going about this. We simply don't have that within financial services. I wrote about this quite extensively in my book. Now, that fuels the cynicism that I alluded to earlier, because I think that there is competitive advantage in this. And another really, really important dynamic in this, and this, as it were, goes back to the point we were making about regulators, is that you haven't just got financial institutions jockeying for position and competing with each other in the marketplace. You also have jurisdictions that are competing to attract as large a slice of the capital action as they can. So whilst most of them do ostensibly comply with the FATF recommendations, you only need to scratch the surface of the legislative and regulatory regimes of many of those jurisdictions to see that they have carefully calibrated their laws and their regulations to give themselves a little bit of competitive advantage over other jurisdictions. The United States is the worst offender of any jurisdiction in the world when it comes to that as a particular dynamic. So, that I'm not sure that adds much, but I think it is relevant. It is relevant.
Good, thank you. We have time for one more question. Yeah, there is back there.
With the introduction of GDPR, are you finding more in the industry a desire for the use of blockchain technology as well as encryption, especially when we're looking at data and privacy?
I've got an answer. I'm not sure if it's the answer. So I think that to me, blockchain and the distributed ledger technology feels like Java did in the early 90s. I think the hype cycles started to level out a little bit, and we'll start to see real solutions. I think it's going to only be after, maybe in 2 to 5 years when those solutions become, widespread sort of industrial strength. There's going to be a consolidation. A lot of the smaller companies are going to be purchased or go out of business. And you'll start seeing what I think of as more practical applications of distributed ledger technology. At that point, I think you will start to see it be used more and more by large financial institutions and in fact, by regulatory agencies for privacy.
Excellent. Thank you so much for everybody for joining us on the panel. I hope you enjoyed it. And I think we have the lunch outside. So let's just give a big round of applause to the panelists. And